Welcome back to Forward Finance. In this video, I'll be breaking down how much you need to make in order to afford a 2022 BMW i4 M50, according to a few popular car buying rules. I'll be including 4 different options, and you can decide on which one suits you best depending on how into cars you are. Some people just want a reliable form of transportation, and some are willing to sacrifice quite a lot in order to get the car they desire. Stick around to the end of the video to find out which method suits you the best. Before I dive into the first rule, these videos take quite a lot of time and research to make, so please click the like and subscribe button and comment down below what other vehicles you would like to see. Starting off with the Dave Ramsey rule here. Many of you know Dave, so this shouldn't be too uncommon to you. You must have a 3 to 6 month emergency fund built up. The vehicle cannot be more than 50% of your annual gross income, and you must purchase it in cash. Given that the 2022 BMW i4 M50 starts at $65,900, your annual gross income would need to be a minimum of $131,800. Ideally, it's nice to purchase a vehicle in cash, as you would avoid having to pay interest and your insurance would be a bit lower, but obviously not too many people just have 66 grand in cash lying around. The next rule is the 24-10 rule, which is pretty popular, so you probably heard of that one as well, which is a bit more attainable than the Dave Ramsey rule. This states that you must put at least 20% down on the vehicle, you cannot finance it for more than 4 years or 48 months, and the payment cannot be more than 10% of your monthly gross income. Given that the 2022 BMW i4 M50 has an MSRP of $65,900, you would need to put down $13,180, and with the average new vehicle interest rate of about 3.86%, in a 48-month term, this would bring your monthly payment to $1,187.07. Bankrate states that the average monthly insurance cost is $148, but to be more accurate, use the Smart Financial link in the description below to get the exact value of how much insurance would cost for you. This brings your monthly total to $1,335.07, not including gas. Back to the 24-10 rule, given your monthly cost would be $1,335.07, you would need a monthly gross income of 10 times that, or $13,350.70. This would also equate to a gross income of $160,208.40 annually. Obviously, those first 2 rules can be pretty difficult to achieve, and you would assume the average person wouldn't follow them to a T, which is exactly why I've came up with my own. For my rule, you need to have at least a 6-month emergency fund. You need to invest 15% of your gross annual income into your 401k, and you need to max out both your Roth IRA and your HSA if your company offers an HSA. If not, then that's an optional. Yes, this might seem like quite a bit of saving, but there isn't any monthly percentage rule that you have to stick to. I kind of leave that up to you guys to decide how much you want to spend on a vehicle. You know, if you could be somebody that would much rather go on vacations or go out to eat more, or you could be a diehard car fan that would rather not go on vacation and just enjoys driving their vehicle every single day. That 6-month emergency is there just to ensure that you're covered in the case that anything wild happens, and the investment portion gives you a bit of financial security later in life when you'll need it most. The majority of people would look at this and say, well, nothing's guaranteed, and while that's true, it's difficult to put a value on having peace of mind for yourself or your family's future, so I highly recommend the investment portion before deciding to go with any car purchase. The final rule is the 1/10 rule, which was developed by Financial Samurai, and personally one that I think the majority of people trying to build their wealth should consider. It rarely allows you to purchase a new vehicle, but allows you to spend responsibly, reduce your financial car ownership stress, and increase your net worth over time. This rule is pretty straightforward. It states that you shouldn't spend more than 10% of your gross annual income on a vehicle. It can be new or old, but obviously for the vast majority of people, it would be used. You must own the vehicle for at least 5 years, and the theory behind this is to minimize your financial stress. It could free up some money to invest in assets or opportunities that may come your way. It's much more difficult and stressful making life decisions when you're worried about payments each month. One of the biggest killers of wealth are cars and car payments. Many people get upside down on a car payment and end up losing tons of money. It's generally the most amount of money that somebody would spend in their lifetime on something that goes down in value. So if you think of investing as compounding interest, thinking of buying a vehicle you can't afford as negative compound interest. A mistake like this will set you back years down the road. If you're a younger person, I would suggest playing around with the compound interest calculator to see how much your investments now may turn into in the future. Again, hit that Smart Financial link in the description down below to see what your insurance costs would be. It's different for everybody, your age, your gender, where you live, driving habits, things like that. So I would suggest giving that a look. I also included a Truebill link, and that app gives you an idea of how much you're spending each month and actually takes a look at some of your recurring costs and can help negotiate getting rid of those actually on your behalf. The intention of the channel is to help everyone get a hold of their finances. I appreciate every one of you who stuck around to the end. Please drop a like, subscribe, and leave any future video suggestions, thoughts,